Hello and welcome to the Accounting Buddy. In this channel, our focus is on financial accounting, auditing, taxation, and everything management accounting. Now, if you're interested in these topics, do hit the like button and subscribe to the channel so that you don't miss out on any future content. Today, we're going to be looking at break-even analysis. Now, this is an analysis which is used by management of a company to know exactly the point in which the sales are equals to the costs, right? This is the break-in point. Now, to elaborate, we'll look at the break-even point more in detail. Now, as I mentioned earlier, that the break-even analysis is used by management to determine the point where sales is equals to the costs of producing and selling. Now, if you've watched the previous video, if you haven't, there's a notification at the top there. You can reverse and first watch the video on contribution because it's integrated in this lesson. So now, from the point of economics, as you can see here, where I'm putting the dotted line here, this is the break-even point. In economics, this is called normal profit, where there are no profits incurred and also importantly no losses are also incurred at this point of time. So sales is equals to cost. The revenue in this case is equals to cost. I do apologize for the poor image quality. Right now, from our lesson on contribution, we do know that every cost up until the break-even point is used to cover our variable costs, right? Our variable costs are covered by this uh, sales up to the break-even point, and anything after that is regarded as profit, right? So on the next video, we're going to get into the whole margin of safety, and I'm going to elaborate more on that whole margin of safety. As you can see, it's all integrated in the break-even analysis, so it's quite an important part of the bigger picture of the break-even analysis. There are ways to calculate our break-even value. So the first one is break-even point in units. The formula is break-even point in units is equals to total fixed cost divided by contribution per unit. In this example, our fixed cost is 20,000 and our contribution per unit is 20, right? So our answer here is given as 1,000 units. So this simply means that we need, or the company, in this case this specific company, has to sell at least 1,000 units to cover or to reach a point of break even, where the costs and the sales are equal. So this is the number of units that they have to sell. Now, in terms of the value, in terms of the amount, the value of the sales, we have something called a break-even point in value, which simply means the break-even value is equals to the total fixed cost divided by, this time it's no longer contribution per unit, it's the contribution ratio, right? The contribution ratio, do check out the previous video, but just for this example, contribution ratio is the percentage of sales which is used to cover the variable costs. Remember, there are two sides to cost. There's the variable cost and the fixed cost. So in this case, we have 50,000. So our sales in monetary value would be 50,000. That is when we are going to reach a point of equality or break even. Right? So that's just about it as far as contribution is concerned. Guys, I hope you enjoyed this video, and if you for any reason need any academic support concerning these topics or any of the topics I mentioned, remember I said we are interested in financial accounting, taxation, auditing, and management accounting. You can look us up at Accounting Jenny, that's on Twitter, or you can also look us up on the email there provided on the screen. If there are any comments you'd like to leave, guys, feel free to leave comments on the comment section and I'll attend to them. I'll even give them a thumbs up when I see them. See you on the next tutorial. Nda.